Okay, so hello and welcome to the first session of AnD Academy. For those who don't know me, my name is Ellie Perlman. I'm a partner at AnD Ventures. It's a venture capital firm located in Israel, focused on early stage startups. As I said earlier, this session is recorded for the benefits of others who cannot join us today. And if you have any questions, they will be addressed at the end of the session. During the session, please write them in the chat. And also feel free to put in your LinkedIn profile in the comments if you'd like to follow up a discussion. Both Ellie and myself will do that as well. So we're gonna kick off this session this afternoon on how to evaluate real estate deal as a passive investor, best practices, tricks, and pitfalls by Ellie Perlman, owner of Blue Lake Capital. Just a quick intro on Ellie. As I said, founder of Blue Lake Capital, has over a decade of experience in real estate investment, law, and property management. Ellie leads Blue Lake Capital, which owns management and managed over 2,900 multifamily units across the U.S. with a total net worth of over $620 million. Ellie started her career in Israel as a commercial real estate lawyer, leading real estate transactions for Israel's largest development company. She holds an MBA from MIT Sloan School of Management, Bachelors and Masters in Law from Bar-Ilan University in Israel, as well as a bachelor degree in law. Last, Ellie is a Forbes author on real estate investing and a host of a popular podcast, Ready to Scale. So without further ado, Ellie, I'm going to pass the baton to you. Take it away.
Thank you. Thank you so much. And it's really great to be here today. Just wanted to go over our agenda real quick so you know what to expect. I was already being introduced, so I'm not going to repeat that, but just say that I love real estate. It's hard work, but it's very rewarding, and no one deal is like the other. There's always things. You can be in real estate for 100 years and still learn new things, especially with COVID. We've experienced a lot and learned a lot. But today I want to talk to you about some best practices on how to evaluate a real estate deal, some pitfalls, and that's from my experience both as a sponsor and operator, but also as a passive investor. So I'm a passive investor myself. In each and every of my deals, if the deal's not good enough for me to put my money in and my family's money in it, I'm not even going to bring it to investors. So I want to talk about that. How do you, as a passive investor, what to pay attention to, and I'm going to kind of tell you some secrets behind the scenes from how us operators work and how we underwrite deals. And I want to also leave some time at the end for Q&A, for some questions. Probably 15 to 20 minutes. But if in the meantime, if you think of anything that you would like to ask or anything that you want me to talk about, you can use the chat and just send us a question, and I'll make sure to address it. So we can start, and maybe I'll give you a little bit more of a kind of color of the type of deals that we're buying. We usually look at, I want to say 300 to 500 units apartment, complexes, normally in the Northeast or in the Southeast. We're active in many markets in the US, and we like to purchase assets that have some value add component. And when I say value add component, I mean, if we purchase a 300 unit apartment complex, it's usually garden style. So when you walk in, you have a gym and a pool and a leasing office and maybe 19 or 25 different buildings. Usually it's 2 to 3 story buildings, and you can have 300 to 500 units, sometimes more. And that's the type of assets that we manage. And I like to buy assets that have value add, meaning we can, we walk in and we see that maybe the gym is a bit, old. Maybe the pool hasn't been maintained very well, and the units, they look old. So we understand that, hey, if we can get in, we can basically do some renovation work, maybe remove the black appliances and put stainless steel instead, remove the laminate countertops and put granite or quartz, and then we can push rents. And this is how mainly, this is the number one way of making money in multifamily, which is, what we do. We basically improve the properties, we streamline the operations, we cut some costs, and we were able to push rents, I want to say on the lower end, between 10% all the way to 59.9% in the past 24 months, with an average of 24-25%. And I believe the average in the US for rent increases is about 17%. And so when we're able to do that, this is how we're basically, making money in real estate. So wanted to start with the best practices for how to, of evaluating real estate deals. And normally I'm talking about multifamily, but some of the things I'm going to cover today, you can definitely implement on other asset classes. The first thing, before you even look at any investor deck, look at any deal, is to do due diligence on the sponsor. And it sounds like it's, of course we're going to do due diligence, but there's some things that that are very important. I always do my own due diligence on sponsors that I invest with before I even look at the deal, because I don't want to be, I don't want to focus on the deal and how good the numbers look like, because if I don't trust and I don't like the sponsor, then it's not really where I want to put my money in. So it starts with the easiest thing, like Google them. If there's anything wrong, if they were involved in any litigation, SEC, violation, you'll see it on Google. It will pop up. It's very hard to get rid of those, of those records. And I always say, hey, ask to speak with the company directly. There are other platforms out there for crowdfunding, but you kind of miss the direct relationship with the sponsor. And so speaking with them, seeing how they communicate with you, if they're open to talk about, hardships and how they've been treating investors during COVID. That's one of the things you don't get from just reading on the website or just investing without talking to the team. And I always tell my investor, I always say, ask hard questions. Ask them, how have you, what are your, how have you been doing, through COVID? Or have you paid investors on time? Have you paid yourself your fee? Can you share some, a time when investment didn't work out, and see how they react to those questions? Because an honest sponsor is always going to tell you the truth, obviously, and this is a type of sponsor you want to associate with and you want to invest with. There's always, in real estate, always a deal that went wrong. There's no such thing. Someone tells you that everything is fine. They're either inexperienced or they're not telling you the truth. And you want to see, it's not about the fact that someone had a deal that did not work the way they wanted, but how did they, what did they do? How did they respond? What did they communicate with investors? So for example, we bought a 250 unit portfolio in Atlanta. And when we put the deal under contract, occupancy was 98%. And then a week before closing, we found out that the seller was hiding from us the fact that the property's occupancy went down to 82%, which means that besides getting almost over 30 units that were vacant and not making any money, not producing income, the property was not eligible to get any funding, at least not the funding that we were planning to put on the property. And so basically what we did, we went back to investors and said, hey, this is a situation where a week from closing, or actually it was 3 days before close or 4 days before closing, this is the problem and this is how we're going to fix it. And we have a plan, and we were able to raise income to 90%, the occupancy to 90% within less than 2 months. But communicating that with investors was crucial and that gave investors also the comfort that if something goes wrong, we're not going to hide it from them. We're going to tell them exactly what's going on. So when you ask sponsors hard questions, this is how you understand, hey, if this is the type of sponsor you want to invest with, and how they're going to treat you as an investor. And don't be afraid to ask them for the projections versus actual reports. It's something that many sponsors don't feel comfortable sharing, but every sponsor has that, and you can see per month or per quarter, per asset, what was projected, what was communicated with investors, and how much they actually paid. And that could be a good indication of future performance. So all of that is part of the due diligence that I recommend to do with a sponsor, whether you start with Googling them, speaking with them directly, asking them the hard questions, and ask for some reports. All of that is extremely important. I want to pause for a second before I go into the underwriting analysis to see if anyone has any questions, or are we good to continue?
I think we can continue.
All right, wonderful. Okay, so let's talk a little bit about analysis. And different investors have different appetite for underwriting. Most investors are not going to run an entire analysis, the entire model. But when you do look at a deal's underwriting, and you can ask the sponsor to share with you, or when you're looking at the deck, there's certain things that I would highly recommend that investors actually look at. One of the main things that can really impact the projected returns is the exit cap rate. And so when you're looking at the underwriting, or at least ask the sponsor for their assumptions when it comes to the exit cap rate. So whenever, every time we buy an asset, there's an in-place cap rate. And cap rate is kind of the relationship between the net operating income, NOI, and the purchase price. And generally speaking, obviously, you all know it, the lower the cap rate, the higher the price, and vice versa. And right now, I would say the cap rates for the type of assets that we purchase is around between 3 and 3.5%. And what happens is that when sponsors are underwriting deals, they need to make an assumption on the exit cap rate, meaning what would be the cap rate in 5 years or 7 years when we're going to sell the asset. Now, if they're assuming, I've seen several deals that the IRR looked great, but then when I looked at the exit cap rate, I've noticed that actually cap rate hasn't moved that much, which means that if they're buying at a 3.2% cap rate, and they assume that they're going to exit in 5 years at 3.2, the same cap rate, it means that they believe that the real estate market is going to be as strong as it is today, because the cap rate also signifies, it shows you how strong the market is. And I think it's a very aggressive assumption to make. What we like to do is assume, is plan and operate and work based on, basically plan for the worst, but operate for the best, which means that when we run the numbers, we assume that the market is not going to be as strong, and the deal has to work with a higher exit cap. So if we are purchasing at a 3 cap, we want to see how the deal works with a 3.5% cap rate in 5 years or in 3 years, because we assume that the market is not going to be as strong. And if the sponsor really is pretty aggressive and thinks that the exit cap is going to be the same or lower, then they're basically saying that the market is going to be as strong or even stronger. And that directly impacts the IRR because it assumes a much higher exit price than they can actually get. Now, there are some exceptions. For instance, if the property is purchased off market at a way below replacement cost, meaning that the market cap rate is 3, but you bought it at 4%, which is kind of the deal of the century, and you assume 3.5 or 3.6% exit cap, then I would say this is one of the examples for when it actually makes sense to have that discrepancy between the in-place cap rate which means the cap rate you purchased the deal with, and the exit cap. So if you see a number that doesn't make sense, always good to communicate and ask, tell me how you got to the exit cap, or your, what were your assumptions going, into the deal and looking at it this way. But this is something that a tiny shift in the exit cap rate can really add a lot to the IRR, and then the deal doesn't look, can look great or not so good once you change that. That's one of the things that I would highly recommend to look at. The other thing is to look at the pro forma, and every pitch deck has a pro forma, and to focus on the NOI growth from the current operations. Basically, if you look at the trailing 12 income, minus expenses, that's the NOI, the net operating income. If you look at the growth on the current operations to year one, and understand if that makes sense. So sometimes I see deals that look great, but they look great because the sponsor assumes that they can bring the NOI from, they can increase it from current operations within 1 year, increase it by 30%. I believe it's extremely, aggressive. I would underwrite to a much, much lower number. Sometimes we underwrite to 1 to 3% growth, which is not what we're trying to get, but we're just trying to say, hey, if the deal works with a 3% NOI growth, then it will work with our actual numbers and how we actually going to bring the property to in terms of the NOI growth. Again, there are always exceptions. So if the property is half vacant, that would explain a pretty high, a growth in NOI. But one of the things to really pay attention to is the NOI growth, and make sure that the asset is not, that the sponsor is not being very aggressive. A third point, because again, one of the pitfalls is to kind of hope that you can raise the NOI by 20, 25, 30%, and it's not easy to do. Another point to look at when you're looking at the pitch deck is to look at the rent growth assumptions, or to ask for them. And I can tell you that right now rents have gone up significantly, but on the other hand, expenses have as well, especially payroll. So I believe that a good and a conservative deal is a deal that basically has a pretty conservative rent growth assumption. Usually, as a rule of thumb, many sponsors like to use 3 to 4% as the yearly rent growth. Right now, we've experienced some significant growth in rents, and usually I would say even underwriting to 15 or 20% is not crazy. I'm not going to do it. I'm still going to use pretty conservative numbers closer to the 3 to 4%. But it's important to understand what are the assumptions that the sponsor has been using, and are you comfortable with it? If to get to the returns that they're projecting, they use 12% rent growth because the market has seen 20%, are you comfortable with it? Do you think it's going to continue year over year until you exit? These are questions that you may want to ask yourself and see if those assumptions if you're comfortable with those assumptions, and ask not only what are the rent growth assumptions, but why are you confident that you will be able to achieve it? Because then you may hear different answers that going to open up your eyes and to understand what's really going on, and it may make sense, but many times it doesn't. And I want to talk about 2 more things to look at in the underwriting, and then I have a question here about the interest rates, which I want to address. Another thing to look at, or at least to ask, is about the bad debt. And in multifamily, bad debt is basically all the rents that are delinquent, but we gave up on the hope to really to collect the rent from tenants. So once tenant skips in the middle of the night or leaves, usually it's really, really hard to get the rent back, and then we basically write it off as bad debt, which is kind of a loss. It's rent that they didn't pay and we cannot get back. One of the main pitfalls that I've seen is basically operators that assume that if bad debt is 4% right now, they can burn it off and clean it within a year or two. It's not always easy. It's really nice to see it on paper. It's not always easy because if you're buying in the wrong area of town, or if you have really struggling tenant base, it's really hard to clean the bad debt right away. So make sure that if you're looking at the pitch deck and they have information on bad debt, or if not, ask the sponsor, how are you going to handle bad debt? If right now it's 5%, then a reasonable underwriter / sponsor is going to take the 5% and burn it off over time slowly. Maybe it's 4% in year one, 2% in year two, 1% every other year until you exit. It's much more reasonable than to write it off completely in year one and then, have a 0% starting in year two. And again, there's always exceptions, but understanding the bad debt portion, it's very crucial to understanding whether this deal is conservative or not. And the last point is reserves. We never want to have a capital call. And a capital call can be, in the private equity market, it's a bit different because you're signing the agreement, and then when the fund is closed, then you do a capital call. In real estate, capital call has a bit of a negative connotation because it means we're out of money, dear investors. We want you to fund the projects that we need to do because we can't keep operating the property. And so you want to make sure as an investor that there's enough reserves in the account, that there's enough money as a percentage of the project if things happen. I can tell you that within a few weeks, sometimes the price of goods and services can really increase, and you want to make sure that the sponsor has enough money in reserves. Sometimes we have $500,000 or $1 million just in reserves because we want to make sure that we're not going to be surprised by an unexpected expense and have to go back to investors and ask for more money, which we've never done and hopefully we're not going to do ever. I want to pause for a second, and we have a couple of questions. One is, how are you thinking about interest rates and their impact on future valuation of cap rates? And that's an excellent question. When it comes to interest rates right now, we already see interest rates increasing, and that puts LTVs, puts pressure on LTVs. And I'm not going to say that the multifamily market is softening, but we do see a change. We see fewer groups competing on each deal because the debt is not as attractive, and that puts pressure also on the yield. So some of them are not interested in multifamily, or some of them, and those are usually the groups that are looking for much, much higher returns. I think that as interest rates going to go up, cap rates are going to go up as well. Surprisingly, we haven't seen that happening though, which is why it's pretty hard to see the correlation. Normally, when interest rates go up, cap rates go up as well, which means real estate prices are going down, which makes sense because when interest rates are increasing, then the deal is less favorable in terms of the yields. So you have less of a demand and prices are going down. However, what's unique about the situation where we are in right now is that you still have a lot of capital looking for deals, and they're willing to take lower yields. So even with the increase in interest rates and the compression, basically the LTVs that are going down, it still makes sense to many groups to still invest and go after multifamily, especially because of the tax benefits and 1031 exchanges that are happening right now. So the cap rates are not really moving. And that was surprising to me because I assumed that the moment the interest rates are going to go up or going to move, cap rates are going to react. But right now, there's been a lag, and we're still in the lag time. Cap rates are still holding strong, and they're pretty steady and pretty low at this point. even though interest rates are going to go up, I think the market is just a bit late to react, because there's still going to be capital that is willing to pay the same amount and get less for their money, because there's not that many alternatives right now for them at this point. So in the near future, I don't think there's going to be an immediate impact. We're probably going to see it maybe next quarter, maybe in Q4. I mean, I'm not sure. Different question: is there a delay with construction with the current demand? How does this impact? How does this affect projections? Unfortunately, yes, there is a delay in construction. So what happens is construction companies, they're having a hard time finding employees, and they're slammed with so many projects that they are many times behind schedule. And it does impact projections. If you're not conservative enough, then you're falling behind. We always have a buffer, so we're doing okay in that regards, and we're still hitting projections. But right now, what happens besides, well, when it comes to delays, it means that A, prices are still going up, and because you're delayed, you're paying higher prices. So having reserves is very helpful. And B, you're not seeing the premiums that you wanted to see, because if you thought you can finish renovating a unit in 2 weeks or 2.5 weeks, now it takes you a month. So you're losing that delta. That's income that you're not realizing. So again, in our underwriting, we actually always double the time. We always double the time that it takes to actually renovate a unit. We've always done that. It's always 4 weeks instead of 2. So we're still okay. But if we were underwriting more aggressively, it would have been an issue. But yeah, it's something that many groups are dealing with. Unless you have an in-house construction team, very hard to hit the deadlines that you've underwritten to. But again, if you're conservative, then you should be fine. All right, let's see if we have any more questions before we move forward. All right, awesome. So we talked about the due diligence that is recommended to do, and kind of the process to go over that with the sponsor. We talked about the underwriting analysis, and the third part is the business plan, and then the debt. So it's already 3:40 p.m. Pacific time. I'm gonna go over it pretty quickly because I want to leave room for more questions at the end. And we touched on it a little bit, but when it comes to the business plan, as a passive investor, you want to make sure that you understand the renovation scope, because that's key when it comes to multifamily, and really the renovation is what's driving the income and the profit. So look at the dollar amount and try and think if that makes sense. Renovation of a unit of, I would say, over, close to 20,000 or more than that, probably excessive. And we're not renovating our own house. It needs to be nice, but not too nice, because we still need to get some returns. And we were looking at the ROI. So we're looking at the dollar amount and ask to see the dollar amount and whether it makes sense. I would say for the most part, you're looking at, on the lower end, $5,000. Usually it's all the way to 15,000. And I would say 10 to 12 is kind of the sweet spot. And also look at the scope. Does it make sense to put, courts? You really need courts in that, market. And what's important is to ask the sponsor, how did you come up with this scope? And what we do, for instance, we actually call each and every competitor in the area. We ask for the premiums and we ask for the scope. So we know, okay, this market really likes stainless steel appliances and granite countertops, but they don't care about, the carpet, for instance. So understanding the scope and what tenants actually want is that's pretty crucial to the success of the deal. What's not good is the sponsor that keeps implementing the same scope over and over because they're used to, or because they have an idea of how a unit should look like, because then you can You can just renovate and throw money that on a unit that you don't necessarily need. You're not gonna be able to collect $300 or $400 premiums, and that would be a shame. Always ask, do you have a plan B? What if you start renovating and nobody would want to pay the premium, or it's going to be very hard for you to pay the premium? What then? What then? So important to understand if the sponsor has plan B. And also ask, what due diligence, can you walk me through the due diligence with the comps or with the sub-market to justify your business plan? You want to make sure that there has been that a certain amount of due diligence has been done, and the sponsor actually understands what is the scope of the business plan, not only with the renovations, the unit renovations, but with the curb appeal, with rebranding, and all the other amenities. That's very important to understand. Last but not least is debt, and that's probably the most boring part, but the most important part of the deal, in my opinion. Good, debt structure can, or a bad one, can make or break a deal. So understand, whether it's a fixed or floating rate and what you're comfortable with. I would, also ask, who's guaranteeing the loan? You wanna work with a sponsor that is guaranteeing the loan, so they're on the hook if something goes, sideways, if something doesn't work out. Understand if they took into account prepayment penalties. Sometimes can be $2 to $4 million if they are taking a 10-year loan, but they're exiting at year 7, and that will eat, a big chunk of investors' returns and profits. So make sure that they have that embedded, or that they have a plan B of doing something to not pay it. So I can share with you that for us, we like to take longer term loans. So if we plan on buying the asset and hold it for 5 years, we like to take a 7-year loan, because what we're going to do, we're going to basically exit as a loan assumption. And that's what we're doing right now, actually, on the deal that is yielding 46% net IRR net to investors, 1.8x in 18 months. And we're able to do it and avoid paying prepayment penalty, because we're basically exiting a 7-year loan after 18 months, but the buyer is assuming the loan from us. So there's no prepayment penalty. The lender still has the loan in place, just a different borrower. So we took that into account. We avoided paying, I think it was 2.4 million or 2.2 million in prepayment penalty. And that's money that will keep to investors. We're not spending that money, which is great. And of course, make sure that the LTV is conservative, the loan to value. We like to buy assets around 65% LTV. Some groups are buying, around 80, which is pretty aggressive. But again, there's no right or wrong here. It's just a matter of what you feel comfortable. I like to be more on the conservative side. Maybe it's because I used to be a lawyer in my past life. But we just tend to be more conservative in nature. But that's basically it. When it comes to investing in real estate, do your due diligence on the sponsor, look at the underwriting analysis of the pro forma and ask the right questions, look at the business plan, whether it makes sense or not. And of course, look at the debt structure and see if it's something that you feel comfortable with, because of course the debt is senior to equity and the lender is always going to get paid first. And I'm going to stop here about 15 minutes, I think, before the end of the hour to see, if anyone, if you guys have any questions that I can answer.
One more question. On deals like this, are you guys also handling the management of the renters? Or do you guys hire outside rental management companies?
So we actually hire a third-party company and we manage them. So we have on each asset about anywhere between 5 to 12 people. and they're spread out across, across the US. So we found that it was actually better to our investors to partner with different companies that have a very strong presence and experience in certain markets, and they're hiring people, they're basically training them, and we are managing them, and we speak with them once or twice a week per asset, and we go over all the reportings and direct the management of that company. But that's how we operate.
Great, thank you.
And then I
Ellie,
see
are you
another
seeing
question.
more?
Yeah.
That's my question. I'll just ask it. Are you seeing more institutional investors buying multifamily? I mean, the Blackstones of the world kind of coming in and, just paying over ask and ridiculous about pricing. Is that exaggerated? That's real, or?
It's actually interesting that you asked this because they're actually more constrained than we think. There are more institutions that are interested in multifamily, but there's some things they cannot really do. Some of them, so it makes it harder for them to compete. Some of them cannot do a quick close of 45 days because they have, committees and they need to go through a certain process. And if we come in and we say, hey, we can close it in 40 to 45 days, which we've done in the past, which is kind of a secret of how we win deals, then the seller is going to prefer to work with a non-institutional buyer. I see they're definitely more interested than in the past because they have a lot more capital to deploy that they haven't deployed in the past 24 months. But they have pretty strict rules when it comes to the time. Well, timing is kind of impossible for them sometimes, but the LTV, they can't just decide to invest at the 72% LTV if the group is or the committee is blocking them from doing anything beyond that. So some deals they're still offering, but they cannot compete in terms of pricing. So they're actually on the other side. They're on the other side of the spectrum. And then lastly, when it comes to hard money deposit, they're not that, they have their own rules. So if we're able to put 2 million down within 3 days of signing the purchase and sales agreement, and that's non-refundable, many of them can't do it because they, when we do it, we take the risk that Bullock is going to lose that money. I don't take investors' money and risk it, and I'm willing to take the risk. Institutions, they can't do that. So they don't have that flexibility that many private groups have. So in short, yes, I see them interested more and more in multifamily, absolutely. But competing on price is not where their strength is. And so the sellers need to choose sometimes between going with the highest bid or going with a big group that made an offer that was lower because they think they're more likely to close. I can tell you that one of the deals that we're selling, there was a very big, I'm not going to name them, but very big institutional buyer and another private group. And I chose not to go with the institutional buyer because I knew that they had more restrictions. They could not compete on the hard money deposit. And I thought that when someone is putting 1.5 million hard money, they're more likely to close, even if they're not the JP Morgans, of the world. So.
Thank you.
All right, more questions. How long do you expect to hold a property? Usually, I would say 5 years is the usual time frame. But every year we sit down with the asset management team and the acquisitions team, and we say, hey, does it make sense to hold the property? So one of three things are going to happen every 12 months. A, we're going to say, it's time to refinance. B, it's time, or no, we should keep, hold the property. And C, this is the time to exit, and we can actually hit or exceed investors' returns in a much shorter, hold time. And so usually it's 5 years. We had one asset that we're exiting right now that we planned to hold for 7 years and we held it for about 4 or 4.5. So if we can exit early, return investors their money, as long as we're hitting the equity multiple, the IRR, we're very happy to do it. And who doesn't want to make double their money in 2 years rather than 5? I had one investor that complained that said, now I need to find a new investment in 2 years. I thought that I'm good for 5. But it's that's the only person who complained about it, and he's very, very close to me. So I basically said, this is, I don't think it's the right way to look at it, but of course everyone is entitled to their own opinion. Another question: what size deals do you generally focus on? 50 million to 150 million in deal volume is what we're looking at. And right now, we're looking to purchase larger portfolios to take advantage of, we want to get more discounted assets. So that's the next thing we're going to focus on. But normally anything, less than 50 million is not very interesting to us. 100 million is our sweet spot. And that's usually the deals we do is 80 to 100. And that's the deal size, not equity check. Do you have a fund or raise money on a deal by deal basis? We have both. So we have a fund called Rev Fund, so our $100 million fund, and it's open and accepting commitments. And we also offer investors the opportunity to invest on a deal by deal basis. Everyone is different, and some investors like the idea of a fund, and some investors like to actually look at the deck and decide, basically that some deals they feel more comfortable with, or some markets. What's the average IRR you're looking for? Today, anywhere between 12 and 14% net to investors. Again, because we're very conservative, sometimes to a fault, it generates those IRRs of 12 to 14%. If I'm going to see anything that is higher than that, I'm probably not going to show it to investors, because I want to keep it pretty, conservative. And I think that probably 12 to 13 is what we see on most deals, and that's what you can expect. If you see a 20% IRR, for instance, on a multifamily deal today, probably means it's either the sponsor has aggressively underwritten the deal, or it's maybe in the wrong part of town, kind of a pretty rough neighborhood, which you may hit that. But again, like everything else in life, it's high risk, high reward. So as long as you're comfortable with it and you walk into the deal with eyes wide open and there's full transparency, then that's fine. But this is the average IRR that we're looking at. It's kind of a range of 12 to 14, maybe 15%. Usually 12 to 14% is what we're looking for, which is about 1.7 to 1.9x within 5 years. Usually that's the correlation. And about 5-ish% cash on cash, excluding sale proceeds. With the sale proceeds, it's about 14 to 19%. So if you take the cash on cash from operations over 5 years, plus the income from the sale, then divided by 5 years, and the average yearly, average annual return is 14 to 19%, all in, maybe 20. I don't see any other questions. So I think, I think that's it. I hope I didn't bore you too much, but when it comes to real estate, there's just so much to talk about, and things change all the time. And it's a really exciting, field to be in and see all the changes. So I definitely, again, I love real estate. I was in real estate law, and then property management, and investment is the most exciting part, but also the part that will keep you up at night sometimes to think about solutions, which legal is not like that. At least wasn't for me. But yeah, I was very happy to be here today and meet you all. And and I appreciate your time.
Excellent. Thank you very much, Ali. It was wonderful. I think on the contrary, you didn't bore anyone. The amount of questions were amazing. I think if we doubled the amount of people attending this webinar, probably we're going to be staying here. I would be staying here for up until morning here in Israel. I really like the questions. I want to thank everyone for taking the time to attend today. Ellie, again, thank you very much. And we'll see you on the next AnD Academy. Have a great day, everyone. Cheers.
Thanks, everyone.
Thank
Thanks,
you.
Goodbye.
Bye, guys.